Dear students, in the present lecture, we are going to learn a very important aspects of an auditing, that is valuation. We discussed what is meant by valuation and what are the basis of valuation. Presently, we are focusing auditors duties in connection with valuation. It is the duty of an auditor to verify assets and liabilities of the concern. The auditor has to report that the final accounts give true and fair view of the profit or loss and state of affairs of the business. It means that balance sheet shows asset and liabilities of the business concern. The auditor is responsible for valuation of assets and liabilities, not only for the client but to the third parties also. It is the responsibility of the auditor to give true and fair view about the state of affairs of the business to the client as well as third parties. It means that no asset or liability shown in the balance sheet is either overvalued or undervalued. The asset must have been valued on the basis of some principles. Generally, assets are valued on the basis of principles laid down. Therefore, the proper valuation is possible, and auditor should see that there is no overvaluation or undervaluation of the asset. In respect of auditor's position regarding valuation of asset and liabilities, the following points to be noted. In case of valuation of assets as well as liabilities, the auditor should consider under mentioned point. The auditor is not a valuer or a technical hand to estimate the value of asset. This point is noted that the auditor is not a valuer and technical experts in specific area. He is also not expert for valuation of all type of assets and liabilities. Therefore, he has required to rely on the valuation made by the expert, and he can use common sense about it. The auditor has to verify the values shown in the balance sheet and ascertain that these are fair, reasonable, and in accordance with the accepted commercial principles. Though auditor is not a valuer of assets, but he can see the valuation shown in the balance sheet is done properly on the basis of certain reasonable grounds, commercial principles, and the valuation made by the client is fair. The auditor has to satisfy himself that the assets and liabilities are valued on the basis of gaps. Valuation of assets and liabilities is to be made on the basis of generally accepted accounting practices. These practices must be constant, fair, and followed by considering accepted accounting principles. The auditor should examine that the principle and basis of valuation of assets are followed consistently for years. Accounting policies principles are essential for proper working of the organization and maintaining accounting of the concern. There are certain basis of valuation, namely cost price, book price, realizable price, break-even price, etc. Therefore, the auditor should see that the basis of valuation are consistently followed. The auditor can obtain a certificate of valuation from the expert, surveyors, valuers, directors, or any other responsible officer whenever necessary. Though auditor is not a valuer, but he can obtain the certificate regarding valuation from the experts like surveyors, valuers, directors, or other responsible officer. But the auditor has to take utmost care and see that the values referred are reasonable, practical, and as per the accounting principles. The auditor should not accept the valuation blindly. Though auditor is not a valuer, he rely on the valuation made by the expert, but auditor cannot blindly accept this valuation, but check the valuation with the available documents and evidences. All relevant facts and evidences may be taken into consideration in ascertaining the fair value of assets. Fair value of assets can be approved by the auditor on the basis of documents and evidences. The auditor is not expected to give assurance to repay all the losses to the client and to the third parties who relies on the balance sheet certified by him and suffered a loss. It is very important auditor is not expected to give assurance to third party or client about the losses. However, the auditor bound to exercise reasonable care and skill before certify the balance sheet. Before certifying the balance sheet, the auditor should take proper care and utilize his skill regarding valuation. In case the auditor is not satisfied with the method of valuation of any particular asset, he may seek the advice of the expert. There is a chance to an auditor to get advice from the expert if he is not satisfied with the valuation of asset. Where the auditor finds doubts, he should make his own inquiries. Whatever his observations should be clearly stated in the report. A auditor has required to give his report regarding the financial position of the client or concern. For the while giving a audit report, the auditor should record the observation made by him and doubts regarding valuation of assets. If an auditor takes sufficient care to see that the valuation made on principles accepted by businessmen as sound and correct and as are generally followed by similar business, he is not held responsible for the values set against the assets. Hence, the auditor should take every care that will absolve him from the charge of negligence. If the auditor has taken proper care, shown particular skills, alert in his work, then he will absolve from the charge of negligence regarding valuation of assets and liabilities. So, auditors' duties in connection of valuation discussed here. Now we are going to take into account fixed assets. Then we will discuss the how valuation is to be made regarding fixed assets. In simple language, fixed assets are those which are required for use in the business to earn income and they are not purchased for resale. In this meaning of fixed asset, there are two important things. One is fixed assets are purchased for permanent use and utilized to earn income, and they are not purchased for sale or resale. The definition given by the Institute of Chartered Accountants of India regarding fixed asset is given here. Fixed assets are those which are acquired for the purpose of use in the business with the object of earning revenue and which are not intended for resale at a profit and conversion into cash in the ordinary course of business. So, by considering this definition, we analyze some things from this definition that fixed assets are purchased for use in the business. The object of purchasing fixed assets to earn revenue. The intention of purchasing fixed asset is not resale and fixed assets are used in the business. Another definition given by D. Paula, fixed assets are those assets of a permanent nature which are acquired by an undertaking with a view to earning profits for a period of years by the use of them, and such assets are not held for the purpose of resale. So, from this definition, we got certain things like fixed assets are purchased for use in business, fixed assets are purchased for generation revenue in the business, fixed assets are not purchased for resale. Fixed assets are classified into four categories. Category number one, fixed asset which may be written off over a period of time, like or for examples of these goodwill, patents and copyrights. It means that fixed assets are those assets which can be write off and that are goodwill, patents and copyrights. Another category, fixed assets are not subject to depreciation or depletion. For example, land. Third category, fixed assets which are subject to depreciation. For examples, building, plant and machinery, furniture, etc. Number 4 category, fixed assets which are subject to depletion. For examples, mines, coal fields, oil wells, etc. It means that there are four categories of fixed asset. Number 1, fixed asset which can be written off, fixed assets which are not to subject to depreciation or depletion, fixed assets which are subject to depreciation, and fixed assets which are subject to depletion. These are the four categories of fixed assets. Firstly, we are going to discuss valuation of intangible fixed asset. Also, according to Tangibility. There are two types of fixed asset, tangible fixed asset and intangible fixed asset. Now we are discussing valuation of intangible fixed asset. The assets which can neither be seen or touched, but they are valuable to the business and which can be brought or sold are called as intangible fixed asset. This is the definition of intangible fixed asset. Intangible fixed assets are the assets which can neither be seen or touched, but they are valuable to the business and which can be brought or sold. For examples, goodwill, patents, trademarks, copyrights, technical know-how, tenancy rights, etc. Intangible fixed assets are attached to the business and they go with the business. If there is no business, they will have no value. If the business is not exist, indeed intangible fixed assets have no value. The benefits of such assets are spread over a period of time. The auditor should take into account the following factors about valuation of intangible fixed asset. For the purpose of valuation of intangible fixed asset, the auditor should consider following factors. Normally, intangible assets are valued at cost. If the asset is self-generating, the expenditure incurred for bringing the asset into existence would be considered as cost. If the asset is purchased, expenditure incurred for acquisition of the asset would be considered as a cost. It means that normally intangible assets are valued at cost, and there are two types of things which may be taken into account regarding intangible fixed asset. If the intangible fixed asset is self-generated, then the expenditure incurred for bringing the asset into existence that would be considered as a cost. If the asset is purchased, an incidental expenditure for acquisition of the asset would be considered as a cost. Generally, proper amount is written off every year. It means that in case of intangible assets, these expenditure or the buying price can be written off every year. If the asset is having proper legal term or validity period or a period of lease, the value of such asset should be written off by spreading the amount over the period. By considering the period, the value of intangible fixed asset can be written off. Now we are considering another aspect of valuation of vesting fixed asset. Earlier we discussed the valuation of intangible fixed asset. But presently we are discussing valuation of vesting fixed asset. The value of vesting fixed asset goes on decreasing or depletion due to extraction of materials therefrom. For examples of vesting fixed assets are quarries, mines, coal fields, oil wells, etc. Extracting minerals from mines, stones from quarry, oils from well, etc. Reduce the quantities in the mine, quarry, oil well, etc. So it is called as wasting assets. In other words, continuous operation of extracting materials leads to gradual decrease in the value. If there is no extraction, there will be no depletion. This statement is very important. If there is no extraction, there will be no depletion. The auditor should take into consideration the following factors about valuation of wasting fixed asset. Generally, wasting fixed assets are valued at original cost less depletion on the basis of estimated exhaustion or extraction from such asset. It means that wasting fixed assets are valued on the basis of original cost minus estimated extraction. The auditor should note that it is not easy to estimate correctly that to what extent the material is extracted and to what extent it is still left in that. This is very difficult task. One cannot judge the nature. Therefore, it is not easy task, but the auditor should consider that fact regarding wasting fixed assets. Another aspect of our discussion is valuation of fictitious assets. The word fictitious literally means fake, imaginary, or not true. Hence, fictitious asset means the asset which are not actually asset of the company, though these assets are shown on the asset side of the balance sheet. Fictitious assets are the examples or the expenses or losses which are not fully written off, not offset in the profit and loss account during particular accounting period. These expenses or losses spread over more than 1 years. In fact, fictitious assets are not the asset but they are deferred revenue, expenditure or expenses. Fictitious assets are to be written off during a particular period of time. Fictitious assets have no physical existence. They have no realizable value. Some examples of fictitious assets. Firstly, we consider what are what points are essential while valuing intangible fictitious asset. Fictitious assets are the assets which are not actually in existence. They are fake. They are deferred revenue expenditure. But these fictitious assets are shown on the asset side of the balance sheet. Certain examples of fictitious assets are given here. Number one, Preliminary expenses or formation expenses. Preliminary expenses are the expenses which are incurred at the foundation stage of the company. These expenses are also known as initial expenses, and preliminary expenses is considered as fictitious assets. Discount on issue of shares or debentures. It means that at the time of issue of shares or debentures, discount allowed on them considered as fictitious asset. Loss incurred on issue of shares or debentures. Loss on account of issue of shares or debentures treated as fictitious asset. Expenses of advertisement campaign, promotional, especially marketing expenses of a business. Underwriting commission. At the time of issuing securities, underwriters are appointed and they get commission for selling or issue by selling debenture or shares by them. Profit and loss account, that is loss. Loss is also treated as fictitious asset. While checking valuation of fictitious assets, the auditor should consider the following factors. It means that checking of valuation made by the client is the responsibility of an auditor, and at the time of checking of fictitious asset, the valuation of it, the auditor should focus under mentioned points. Underwriting portion of fictitious assets are shown as asset under the heading miscellaneous expenditure losses in the balance sheet. The written off portion of such expenditure or loss is to be shown to the debit side of the profit and loss account, or this written down portion is recorded to the profit and loss account. Thus, the value of such asset is equal to total expenditure incurred minus amount written off. The value of fictitious asset can be ascertained by considering the total expenditure minus amount written off. So, this is the brief information about the valuation. In the present lecture, we discussed auditors' duties in relation to valuation, categories of fixed asset, valuation of vesting fixed asset, valuation of intangible fixed asset, and valuation of fictitious asset. From this discussion, we can say that valuation is not a job of an auditor, but he relies on the valuation made by the expert. But it is the duty of an auditor to see certain facts, documents, evidences regarding valuation made by the client. So, valuation is important aspects of auditing. Though auditor is not a valuer, he is not expert, but he cannot be away from his duty. Therefore, making valuation of asset is the responsibility of client, but it is the duty of an auditor to see that whether the valuation is made on the basis of generally accepted accounting principles. So, in this way, we are concluding our speech here. Thank you.